Hello, and welcome everyone to today's webinar on multifamily gap financing. I'm Caitlin Snyder, and I have the pleasure of serving as the Managing Director of National Housing and Rehabilitation Association. We know there's a lot of uncertainty in the market right now, and we've put together a great panel to talk through how to close gaps in your deals. I wanted to touch on just a few housekeeping notes before we get started. This webinar is being recorded, and the recording and slides will be sent to all attendees. Please submit your questions through the Q&A box in Zoom. We're going to take them both as we go and at the end. And I wanted to thank everyone who was at our Spring Developers Forum last week in Marina del Rey. We had a really wonderful event. We're editing the recordings right now, and they're going to be available very soon. And we hope to see you next month in Boulder for our Summer Institute, June 17th and 20th. So turning to today's webinar, I wanted to thank Excalibur Capital and Castle Green Finance for their support and partnership over the years and for today's webinar. They brought a lot of financing solutions to the market, and they're continuing to innovate, as you're going to hear about on today's webinar. We've got a great lineup of speakers. Randy Eckers is here to moderate the discussion. He's a partner at Reed Smith with over 25 years of experience as a real estate attorney. Sal Tarcia is the managing partner at Castle Green Finance, where he manages and oversees all aspects of the CPACE financing platform. Jeff Goldberg is the Chief Credit Officer and Executive Managing Director at Excalibur, the sponsor of today's webinar, and he's responsible for originating, structuring, managing, and strategically growing their multifamily platform. And finally, Chris Riley is the president and CEO of Lexington Partners with over 30 years of property management experience. And with that, Chris, I will turn it over to you and invite all of my speakers to come on camera. There they are. All right, Randy, it's all yours.
Nice to see everybody. Thanks for joining. Well, welcome to the webinar on the effects of tariffs on the new selection of the Pope. No, but we're happy to have everybody, and as you'll see, we have a great lineup of panelists here, and I think everybody will get a really good view into some of the more creative ways of financing multifamily. I think the best place to start maybe is Chris with you, since you're the developer on the panel. Tell me about some of the challenges that you're facing in securing sufficient capital for some of your new construction, rehab, or even existing projects. What's going on in the world that you're experiencing?
Well, as I've said for the last couple of years, nothing's easy. Now, with the change in the interest rates post-COVID, it has been a major challenge to a capital stack. So where you've got a challenge in the base now, you've got to get very creative between your primary mortgage and the rest of the capital stack and leverage as much of your equity as you possibly can. And that's become a real issue over the last few years. So tools like bridge lending, mezzanine, and particularly CPACE for us has become much more part of our toolkit than it has previously.
Great. So, I mean, what are you experiencing in terms of rates and proceeds and leverage levels? And where have you been fitting in some of these more creative products like Mez and CPACE?
So depending on the size of the project, our smaller projects, will be somewhere closer to 60 to $100 million. And those will generally get leverage around 65% in the primary. So then we've got to fill the rest of that gap. And we try and keep the equity contributions somewhere between 10 and 15% to keep a decent return. So you've got to get a little creative in the interim. The construction pricing, because we do a lot of ground up development, has started to settle back to not knee knocker rates. We've seen a couple of offers recently in the high sixes, so we're very happy with that at this point. If I had said that over the last 10 years, my partners would have been slapped me upside of the head. But so to be able to fill in that gap with these other tools has become critical for us to get a job and to get a decent return for us and our investors.
Right. Yeah. I mean, so what were the rates a year ago for a construction loan?
Oh goodness, if we could find something that was under 10, we'd have been very happy at that point. So, and to the extent that we can negotiate with the bank and try and get some comfort that we're going to trade in a band, if you will, swaps, create a lot more creative in terms of capping our exposure, but it all comes with a cost.
Well, Jeff, I'll turn it over to you on the bridge lending side of the world. Um, what role have bridge loans been filling recently?
I think quite a bit. Obviously, as you and Chris mentioned, with the rising rates in the sort of post-COVID world, it's definitely delayed the execution on various business strategies in various ways. I think one, coming out of COVID, it sort of slowed the execution on value add type deals, which inevitably has led to delays in sort of permanent financing. So, we've been seeing a lot of requests for refinances for buildings that required between call it 2020 and 2023, where still there's some component of CapEx renovation value add still required, and or given the rate increases, the takeout rates on, say, the GSEs, HUD, CMBS, or other permanent lenders, their proceeds are far less than what they sort of anticipated back in pre 2022. So they're sort of seeking another bridge solution to sort of get them through, hopefully a rate reduction over the next, let's call it 12 to 24 months.
To bridge the period in time to get to lower rates or get to an agency execution, it sounds like.
I'm sorry, Randy, I couldn't hear the first part of the question.
Oh, sorry. So yeah, I mean, yeah, I don't know, my camera, good time for the mic to go. Yeah, so traditionally it sounds like what you've been experiencing and what I've been experiencing is that you would see a bridge loan for an asset that's not quite stabilized yet and not ready for a permanent takeout. But now what it sounds like you're seeing is that plus also a bridge to a bridge, so to speak, where you're bridging a period of time to get to either higher proceeds or lower rate or both.
Yeah, correct. I mean, I'd say pre 2022, maybe upwards of 75% of the volume that we were seeing was for acquisition financing, where folks were looking to a bridge solution to execute on that value add. I'd now say we're seeing close to 75% of the opportunities where it's sort of a bridge to bridge solution, where either haven't yet executed on that strategy, or they're very close to completing the value add, but yet the proceeds on the takeout are just far below what they were hoping for. So they need sort of an interim solution,
Right.
or secondary interim solution, I should say.
Chris, have you experienced that?
Yeah, very much so. We have a real live example of that down in the South. We're stuck on a bridge that we would have already thought to get out of, but between some stubs in operations and just the interest rates, we would not be able to take the existing bridge out without trying to gap again from a more traditional financing. So, we were fortunate enough to negotiate with the initial bridge lender extensions and some rate relief on the loan. But it takes time and creativity.
Yeah, for sure. I don't know. Is there any additional risks or different risks or considerations that you think about before entering into a bridge loan? And it's sort of a vague question, but I'm interested to hear what your take is.
It has given us more caution and thought before we negotiate personal guarantees. In the pre-COVID world, that was almost a secondary thought. Oh, no problem. Don't worry about it. And the reality of the situation now is that those have teeth and they matter. So we're much more thoughtful about how we structure those and how they burn off over time.
Sense. Jeff, have you seen any other concerns on your borrower's part related to that?
Well, the other thing I was going to mention, and maybe this is sort of similar to Chris's experience, is I'd say, we started to see more of these sort of bridge to bridge opportunities last year, but it seemed like last year existing lenders were much more willing to extend those loans. And it seems like coming into this year that maybe the patience has sort of worn thin a little bit, where, these bridge loans or interim loans have been sitting on other lenders' books for now, maybe 3, 4 years. And now is sort of we're exceeding that point. They're telling their borrowers, you know what, actually, we don't have the opportunity or rather the flexibility to offer any more extensions, go find another solution. So I feel like a lot of opportunities or potential opportunities we saw last year ended up going back to the original lender where they just sort of extended, maybe cut some deal with a payoff, maybe reduced rate or some other extension structure. And now we're seeing folks actually execute on, a potential term sheet with a new lender.
Yeah, I've seen the same seat here. Okay, so switching gears, mezzanine financing. Obviously, it fills the void and a gap between the equity and the mortgage loan. I know we have a case study that we'll put up there in a few minutes, but I don't know, Jeff, I don't know, how have you seen, how have you utilized, and I guess this is open for Chris too. Don't worry, Sal, we'll get to how PACE can replace Mez in a minute. But what have you been finding in the mezzanine market in terms of rates? What has it been used for other than just simply bridging a gap? I mean, have you used it for funding tenant improvements for existing buildings or things like that? I don't know, Chris, Jeff, I don't know which one of you wants to jump in first, but I think both of your takes would be interesting.
I get started on this one. So I'm probably oversimplifying a little bit, but I think we've predominantly used Mez or offered Mez in two sort of distinct situations. The first being, as I was sort of talking about before, with rates where they are, the permanent takeout has come in below a lot of borrowers' expectations. So, even though, the GSEs or HUD, they offer pretty attractive rates, with DSCRs ranging between, 115 and 125, or borrowers rather, are not able to hit sort of the max leverage as offered through Fannie, Freddie, and HUD. So, Fannie and Freddie are typically tapped out at 80%, and HUD can go up to 90%. But with those sort of coverage requirements, with rates where they are, you're usually only capping out at 75 and more generally, probably closer to 70% leverage. So where we've been offering borrowers a solution is for those seeking sort of max leverage, maybe back up to 80%, take out sort of an agency, take out a HUD loan, and then we'll sort of fill that gap of, that extra 5 or 10%, and solve for a lower DSCR, so that you can actually hit the proceeds that you're looking for. And another example would be, going back to sort of the bridge solution where, maybe they're seeing they have an existing bridge lender and or a new bridge lender that's only able to get up to a certain leverage point, maybe it's 65, 70. But we sort of see the opportunity to either fund, further CapEx requirements, interest reserves, or, just to complete the cap stack, we could again add, call it 5 to 10% and additional proceeds to get them to that eventual execution of their business strategy.
Chris, anything to add to that?
No, it's not cheap money. That's all I can really say. It does. I remember back in the 80s when Jack Welch was running around, there was this concept of discipline of debt, right? Which makes you get up every morning and make sure you're hitting it as hard as you can and that you're operating as efficiently as you can. It feels like we're back in those times again, not by our own volition, but, just as a way to get you hopefully to the promised land, which we're hoping is 27 or 28.
Funny, everybody was hoping for 2025 a year ago.
Yeah, exactly. The goal line keeps moving further.
Yeah, I know. So I got actually two questions here. So thank you for the questions. And yeah, to the extent anybody has any questions, feel free to send them on. We're hoping to make this as interactive as possible, considering it's still sort of a webinar. So the question was, can you define what each of these terms means? I gather that that question is probably geared towards what is a mezzanine loan. If I'm wrong, feel free to clarify in the question box. But basically, a mezzanine loan is a subordinate loan to a mortgage that's not secured by the real estate like a mortgage would be. Rather, it's secured by the membership interests of the property owner. So a mezzanine lender, if they were to foreclose, they would do it through a UCC foreclosure and then effectively own the borrowing entity, which would still remain subject to the mortgage loan and the mortgage. So hopefully I'm answering the right question. And if I did, hopefully that answers it. There's also a second question here, and I don't know, I'll ask this to all of you because I know Jeff and Sal, we've worked on plenty of low-income housing tax credit deals. But the question is, how can these alternative products fit into a capital stack that includes low-income housing tax credits?
Yeah, so I guess up until this point, at least my commentary has been more focused on existing properties. But we have worked on a number of sort of pre-development land acquisition opportunities as well, where borrowers or developers need some cash to acquire the property before getting, say, their 4% credit or being awarded their 4% credit. And usually, at least for us, we've taken the approach of because we have a HUD underwriting team and HUD license in-house, our goal is to pair sort of 4% with the HUD 221(d)(4) program for new development and substantial rehabilitation. So what we've done is we have provided an acquisition or pre-development loan for the borrower to acquire the property, and simultaneously are processing the 221(d)(4) while the tax credit award is in process. So that is a possibility as well.
Yeah, so CPACE could also be employed on low-income housing tax credits, just given the general nature of them, that they're somewhat cash flow constrained. PACE could be an adequate solution because we get processed as a special assessment or similar to a typical real estate tax, which allows us to provide both lower rates and also very long-term fixed rate financing, which can be more applicable to a project that's going to have lower income and thus have more cash flow constraints. Extending out the maturity period of the PACE component and providing more certainty in terms of cash flows. I think you're muted, Randy.
No, I'm not, but can you hear me now?
Yep.
I don't know. Yeah. So one more question on Mez, and then I think we should move over to the case study that we have for Jeff. But the question here is, how do you consider Mez to be characterized as sort of hard pay or soft pay? Meaning, does interest accrue or is it payable every month? I mean, I have my answer, but Jeff, Chris, how do you want to answer that one?
Yeah, I mean, my general experience has been that it has taken at least some form of hard pay. That's, maybe a portion is deferred, but most mezz lenders in the market are looking for some current coupon or current pay. But Randy, I see you shaking your head yes, so I'm guessing that's sort of consistent with what you've seen as well.
Yeah, exactly. Yeah, most of the mezzanine deals that we work on, they are current pay, that they have to be paid monthly, at least interest. On occasion, you'll see a portion of it accrue if it's not paid, but it's generally not just straight accrual if not paid. This sort of goes hand in hand with I'm sure what people refer to as hard preferred equity versus soft preferred equity, and that's one of the distinctions there. I know we're not getting too deep into that. Preferred equity is sort of like mezzanine financing, the preferred member will have similar obligations owed to it from its borrower slash, it's a company that it's investing in. But those soft preferred deals, which the agencies have a lot going on with, those would accrue. There's no mandatory redemption dates, like there's no real change of control. So that's definitely different than what people consider to be traditional mezzanine finance. All right, I don't know. Caitlin, you want to pull up the first case study, please? All right. So, Jeff, I'll let you introduce this one. This was your deal.
Sure. So this one was a transaction that we provided multiple forms of financing to. When the borrower first approached us, they had almost completed a full renovation of the property. They were near completion, and they were in the process of leasing up the property. So when they approached us, they were seeking a cash out refinance of their existing debt. And we were able to offer them a $13 million loan, which provided about a million or two in cash out proceeds to the borrower at that time, even before they actually fully execute on the business strategy. Over about an 18-month period, they leased up the property to over 95%, and we were able to refinance them into a HUD 223F, which is HUD's refinance program. Unfortunately, just given how volatile rates were between the time of HUD submission and closing, rates had risen about 75 basis points. So whereas we initially thought that the HUD loan will fully support a cash neutral and even a small cash out, just given the volatility rates of that around that time, there actually was a shortfall in proceeds to pay off the existing debt and fund some borrower elected repairs, mostly around some energy efficient improvements. They were looking to install some solar on the roof to reduce utility costs. So at that time, in addition to the $14 million permanent loan, we had structured a small mezzanine loan that sat behind the HUD loan of $350,000, which basically funded their borrower elected repairs. So in total, in that transaction, that secondary transaction, we provide about $15 million, I'm sorry, $14.5 million of debt after providing that initial $13 million refinance. So here we tried to get creative, tried to provide a bespoke solution on that sort of mezzanine offer, which is something that we've been trying to pitch to other folks as well. Obviously, rates have been quite volatile, probably will continue to be so for the near term. So as proceeds on some of these permanent solutions are insufficient to either pay off existing debt and or fund repairs or the other items, we've offered a bespoke mezzanine solution to those borrowers.
Anybody have any specific questions about this particular case study? Oh, guess it was self-explanatory. All right, good. Sal, it's your time to shine.
All right, lay it on me.
What is this C-PACE we're talking about here? Yeah, maybe just a quick, obviously, Sal and I do a lot of work together on C-PACE, but maybe if you could just give a quick overview of what it is, how it works, what it's secured by, and how it could be useful, I think is probably a good place to start. I know I get a ton of questions on a daily basis on C-PACE. I'm sure that pales in comparison to the amount you get, but I think that's a good place to start.
Absolutely. So CPACE is an acronym for Commercial Property Assessed Clean Energy. It is a program that was put in place largely to provide incentive for investment into properties to make them more energy efficient and resilient and sustainable. Uh, Unlike a lot of public-private partnerships that are run at the federal level, PACE is a state-by-state program. The basic premise in all of the states is largely the same. fund for qualified improvements, which include things of an energy efficient nature, water conservation nature, or a building resiliency nature. So these can include such things as upgrading HVAC systems, lighting retrofits, anything that is of an insulating nature to the shell of the building. And in certain states, it can include water conservation measures like low flow fixtures. And also, California and Florida are probably the easiest examples. We can fund in California for seismic improvements and in Florida for wind mitigation. It's also going to include things like your renewables, solar panels, wind generation, geothermal. But for the most part, it's going to be the big fat part of the bell curve on this is going to be those energy efficient improvements. So we can fund for both renovation as well as ground up construction. And then our what's going to look to everybody like a long-term fixed rate self-amortizing loan is processed through the public-private partnership as a special assessment or a real estate tax on the property. So the principal and interest due over that schedule, which can be 20 to 30 years, would be paid just like taxes, and they would be secured by the assessment against the property.
How do senior lenders get comfortable with this? This is one of the main questions and concerns that inevitably gets raised anytime anyone mentions CPACE.
Yeah, that absolutely it is our cross to bear in the CPACE world. Being that we are processed as a real estate tax, the real estate tax payments are senior to mortgage payments. And what generally gets lenders comfortable with this is that unlike a mortgage or even a ground lease that is going to have very rapid rights in terms of enforcement, the trade-off on pace for being treated like a real estate tax is that we also have to act like one. And that really means that we have virtually no rights whatsoever. We do not have the recourse components or even the carve-outs that first mortgages may have. And we have to act in every way, shape, and form like a real estate tax would, which also means that we're not allowed to accelerate our pace. So, for example, if we had a $10 million PACE loan on a project, the only thing that we're entitled to at any particular point in time is the then outstanding payment. So even a missed payment, we're not allowed to call the entirety of the principal amount of the PACE. And even if it were to go into default, any cure or bringing the PACE up to date would simply result in us being brought current on the then outstanding payment. And then we go back to sit in our passive role as if nothing had happened in the first place.
And your mic's out again.
Can you hear me now?
Yes.
Okay. Yeah, I don't know what's happening here. One of the additional protections that we see mortgage lenders take is that they will increase the size of their tax reserve to include the assessment payments so that they know for sure that those assessments are getting paid just like they would for any real estate tax or I don't know, any other special assessment on a property, like a firehouse assessment or a sewer assessment or things like that. Now, what happens, Sal, if so you said it's 20 to 30 years, it runs with the land. What happens if the property owner wants to sell it or the mortgage lender forecloses? The PACE assessment.
That is one of the key attributes of PACE that is to both the benefit of the borrower as well as the first mortgage lender. In the case of a sale, unlike a mortgage, there is no due on sale clause for a PACE. As Randy stated, it runs with the property, not with the borrower. So it may be freely transferred, no transfer fees, no complicated approvals on assumption. It would simply be transferred over to the new owner. Obviously, they would have to agree that they are taking on that obligation. We're going to show up on a lien search just like anything else. In the case of the first mortgage lender foreclosing, it would be very much the same. Any notice and cure rights, which depending on the state and jurisdiction that you're in, can be anywhere between 2 to 5 years of notice, cure, and redemption rights. Those would extend to the first mortgage lender so that they can step in and make a protective advance and protect themselves. Or if they were to go through a full foreclosure and step in, they would simply be subject to the PACE just like any other owner would.
Maybe the most important question. How do the rates compare to mezzanine? Because I've seen lots of little drawings where CPACE is used in lieu of a mezzanine loan. So, Chris, before you said that mezzanine loans are, I don't know, carrying double-digit interest rates. Sal, what's the going rate on average for, I know it's property specific and project specific. What's the going rate for a CPACE assessment?
So typically we price off of the longer end of the yield curve. So right now we're going to have on multifamily, our current deals are mostly in the mid to high seven range on a fixed coupon. What we're finding is that given the flat yield curve and even inverted yield curve that we were dealing with not too long ago, it's really improved the attractiveness of PACE because since we're funding off of the long end of the curve, it's a lot more similar to how mezzanine or first mortgages would price on the shorter end of the curve. So we might be in today's environment half of in a lot of cases of what comparable mezz might be.
New construction, what percent of the hard and soft costs would Mez be able to cover generally?
So typically we're going to be anywhere between 25 and 40% of the hard and soft cost. In places that allow resiliency, where we can fund seismic improvements or other building hardening or wind mitigation, we might get closer to that 40%. In states that only allow energy efficiency and water conservation, a good rule of thumb is about 25 to 30%.
So it's obviously a really great and important tool for new construction. And we do have a question here about look backs. If you can just touch on that real briefly, because I know we have to get to our second case study, which is also about PACE fitting into a capital stack.
Yeah, absolutely. The vast majority of state programs do allow us a look back feature. In more traditional financing terms, it's a way of effectively refinancing or recapitalizing a property that has already finished its initial construction or its renovation, where we can, quote unquote, look back to the compliant improvements that were put in and offer a PACE that could fit into an existing capital stack. We see a lot of these coming out of a very high inflationary environment where the cost overruns gives the property owner the ability, or the first mortgage lender the ability to reduce their exposure by bringing PACE into the capital stack after completion.
Now is as good a time as any to open up the case study. Caitlin, if you don't mind. Oh, perfect. Thank you. So, Chris, the mic is yours.
Right. So this is one park, built in West Hartford, just outside of the capital city, Hartford. The 292 units. We bought it from the Sisters of St. Joseph. They actually still occupy a wing of one of the older portions of the building as an assisted living facility for the sisters. And then with uh, Castle Green's help, we, had to, bring in $10.5 million of CPACE to this deal to help fill in the capital stack. But it was interesting because I sort of sat in the middle on this transaction. My former partner was extremely suspect that we could get this done. Was needed the entire team of Castle Green to really help convince him that we qualified even for the energy conservation because we weren't doing anything that we would have considered to be exotic to the building. So you don't really have to get all that exotic. You just have to use really good modern building practices, and a lot of your bases will get covered by the CPACE loan. And then we needed Sal to do his magic with our first lender and can get them to understand the rights that were associated with CPACE and get them comfortable that they were protected. And it took a couple conversations, but we got them there. So it was a little bit of education on our part and a little bit of educating our lender partners to get this done.
Sal, you want to take this part? This gets into energy savings and energy reports, I assume, and everything that goes along with that.
Yeah, absolutely. It was a real pleasure working with Chris and the Lexington team on this project. Under the Castle Green umbrella, this was actually our very first deal as Castle Green. So we really appreciate the Lexington group entrusting us with this project. We were able to supply a total of $13.7 million on this project. As Chris identified, the net into the hard and soft cost was closer to 10.5 million. We were able on pace to also include interest carry on construction loans that can be capitalized within the pace. So that was the gap. Chris mentioned a couple of very important things. A lot of people have a misconception about CPACE that you have to do these extraordinary energy efficient items or even renewables to be able to qualify. But very often, any part of the project that is of an energy efficient nature that is done to just a simple high level of construction is going to qualify under the program. The Connecticut program is very formulaic. It's one of the more predictable programs in the country. As you can see from the chart here, there is not only financing savings, but they generally offer uh, you know energy savings along the way. So if you're building a project that is going to use PACE, we run what's called an energy audit, and that identifies the eligible improvements within the project versus the baseline energy code that would be employed on your most vanilla projects. And then we effectively prove out the energy savings over in the entire term of the PACE, which, as you can see here, was over $6 million. And then there's also a very sizable reduction in carbon emissions that typically go along with that.
So what was interesting with this job is we entered into discussions with Castle Green early enough in the design process that we could tweak things so that we could maximize the CPACE benefit and do it in a cost-effective way that drove a much better project.
Yeah, absolutely. And we step in very often, with our stable of energy engineers that will typically produce these reports for us. Along the way, they'll also make suggestions to the development team to give them the best bang for the buck of what can be financed through PACE with the least amount of incremental cost over the alternative ways of building the projects. So we consider it very much a partnership with the development team, not only as financier, but also trying to get them to maximize the overall benefit between financing savings and energy savings.
And in the category of rather be lucky than smart, when we did this loan with Castle Green, the interest rate, we thought it was a little higher than what we were paying our primary lender. But at this point, it's a heck of a lot lower than what I would get in the marketplace. Randy, we got your mic problems again.
Of course I do. How about now?
You're good.
Yeah, I don't know what's happening here. So one last question on PACE, and I'll just open it up for more questions and then some general thoughts on the market. But because we're getting a lot of these questions, roughly how many states is PACE available in? Is there a size constraint? Sort of, how is it used? Is there property limitations on the type of assets that can be financed with it?
So I would say from an active standpoint, there's approximately 38 states right now that I would consider having active programs. From a size constraint, we've done deals anywhere from $2 million to well into 9 digits. So the only real constraints are threefold. There is the hard constraint, which is the eligible improvements, which are governed by state statute. So we have to maintain compliance with the state statute. The second constraint is typically our own internal underwriting parameters, where we will set underwriting to a stabilized LTV constraint, both for the PACE itself as well as the entire capital stack. And then, of course, the third constraint is working with the first mortgage lender and the borrower in terms of what is the best mix of first and PACE to satisfy all parties involved. Kind of falls under the category of it works for everybody or it works for nobody. So we will typically issue an initial quote based upon the maximum that we can do both by state law and for our underwriting parameters. And then we will get together with the other financial institutions involved in the deal and the borrower and kind of discuss how we could put together the best capital stack.
Great, thanks. I think we have 1 minute, but I think it's also worth mentioning that PACE is also prepayable. So even though the term is 20 to 30 years, prepays are pretty flexible and can be negotiated. So even though it could be on the property for that extended term, it does not have to be. So it could be a long-term and a short-term tool. I guess last question, we'll just go around the horn. Any predictions for future trends in multifamily financing? Jeff, let's go to you first. I like putting you on the spot.
Any trends for multifamily financing? Well, I mean, I feel like, of the products we talked about today, CPACE is certainly the newest. I think if rates continue to be sort of in this context, I think, these gap financing, secondary financing type measures are definitely going to be a very interesting and appealing tool for borrowers and developers, just as that sort of primary source of financing is debt service constrained to a lower leverage point. So I think if it's mezz, if it's CPACE, if it's pref, I think folks are going to are going to rely on those much more heavily. Again, if rates continue to be here, and who knows what's going to happen with rates. I mean, we're definitely in this pretty volatile period. I mean, I feel like everyone's just responding to the tape. I mean, this morning with UK, US potential tariff deal, the markets love that, and potential for maybe some progress with some other trade deals. So I think it's just sort of a wait and see sort of approach as to what happens on the tariff and rate front. But I do see these types of gap financing solutions being a big part of borrowers' financing solutions, at least for the immediate term.
Sal, just because I want Chris to have the last word.
Absolutely. In times where there is instability, both in terms of volatile interest rate environment and also inflationary pressures, which of course tariffs create a lot of uncertainty. A lot of people typically look for alternative financing solutions for how to shore up their capital stack, or in the case where they've already incurred a cost overrun, which we've seen a lot over the last 2.5 to 3 years, where we can step in and really cure, for lack of a better term, a cost overrun situation and bring in pace to rebalance the capital stack. So, times like these where there's uncertainty, we see a lot more interest and inquiry onto what we can do in pace to solve those problems.
All right, Chris, final word.
Final word is basically
Give us a bold prediction.
bold prediction. If I was good at bold predictions, I'd be talking to you from my yacht in the Caribbean. So that's sort of where I got to leave this from. I don't know how this got to be, but I'm the old man in the shop now, and I got a lot of young people working for me, and I have to tell them to take a deep breath, relax. Things go up, they go down, and we just need to be creative along the way because housing is necessary regardless of what the times are. So we're in a great business. There, you've just got to get creative with the capital stacks, and over the long haul, we'll do fine.
Not sure that was bold, but
What's that?
okay. I'm not sure it was bold, but okay.
We'll take it.
I
That
don't
was
know.
great. Well, I just wanted to say thank you so much to all of our speakers. Randy, I thought you did a great job moderating the conversation, to Sal, Jeff, and Chris. Sal, I wanted to circle back to something you had said earlier around, developers finding themselves with gaps. When is it like too late? What's the right time to come to you if they have a gap in their deal?
What I would typically say is as early as possible. Typically we can give at least some initial guidance on what we can do on the pace side in as little as 48 hours. If we're used to getting involved on deals very early in their process, so our team is quite accustomed to the hurry up and wait scenarios. So, we can give them an idea of where they can go, what a possible solution can be, so that they can confer with their uh, first mortgage lender or mezz if there's multiple layers of the capital stack, as to what everybody would deem to be an acceptable solution, and then come back to us to modify our quote and issue a term sheet to fit that solution.
We have a couple of questions that are all around the same theme. So I'm going to lump a couple together around offsite solar, ownership in a solar farm, and renewable energy credits. Kind of how does CPACE play with those things?
So, if we're talking about ground-based solar or solar that's not directly incorporated with an actual piece of physical real estate. When I say physical real estate, I'm talking about a building, not necessarily with the land. PACE is typically not the best solution for a standalone solar farm, if you will. There are better financing solutions for that are more cash flow based or tax incentive based for those projects. However, if there is solar that is directly related to a building or buildings, PACE can include that as part of the qualified improvement list and be quite an effective solution.
That's awesome. Thank you. Well, I know that we had a couple more questions that we're not going to be able to get to, but please do send them over to us and we'll make sure they get to the right person. Just wanted to thank all of our speakers and our moderator. You will be receiving an email from us shortly with the link to the recording and a link to the slides. But just want to thank you all for the work that you're doing and the housing that you're providing. I think it was Chris, you said, you know, we're always going to need housing and we've got to figure out a way to finance it despite the time. So on that note, carry on and keep calm. Have a good one, everyone.
Thank you,
Thank you
Kate.
very much.
Thanks, everyone.
Bye-bye.